Most traders panic, sell at the exact moment. Professionals are quietly buying everything they're dumping. That sudden brutal drop below support, the one that triggers your stop loss, isn't a breakdown. It's a spring. Large traders deliberately engineer that fear to absorb your shares at the lowest possible price, eliminating weak hands before launching upward. The selling climax, the silent phase B absorption, the deceptive shakeout, it's all orchestrated. Once you recognize the structure, you stop being the liquidity. You become the one riding it. Most traders panic, sell at the exact moment. Professionals are quietly buying everything they're dumping. Every single day, across every financial market, stocks, crypto, Forex, futures, the same devastating scene repeats itself with ruthless precision. A security that has been declining for weeks suddenly accelerates downward. The news turns catastrophic. Social media floods with warnings. Your portfolio is bleeding. Your chest tightens. And in that exact suffocating moment, your trembling hand hits the sell button. You think you are being smart, disciplined, protecting yourself. You are not. You just handed your shares to the most powerful, most patient, most calculating force in the entire market, and you gave them to him at exactly the price he wanted. Stop. Before you execute another panic-driven decision, understand what is genuinely happening beneath that terrifying price action you are watching. That aggressive, confidence-destroying decline did not happen by accident. Nothing in the financial markets of significant magnitude ever does. The same ticker you are frantically selling right now, the one appearing on every bearish screener, the one financial commentators are warning their audiences to avoid, is being accumulated in extraordinary size by professional operators who have been planning this campaign for weeks. They need your panic. They depend on it. Here is the mechanical reality of modern markets that every serious trader must internalize. Large institutional operators, hedge funds, proprietary trading desks, algorithmic accumulation programs cannot simply place one enormous buy order and establish their full position. The sheer size of their capital would immediately shift the price against them, destroying their own average cost before the position is even built. So instead, they manufacture the conditions necessary to absorb supply gradually and invisibly. They allow, and sometimes deliberately engineer, a selling climax. A violent, high-volume capitulation move that drives retail participants into pure emotional liquidation. Every stop loss triggered below support becomes a sell order. Every panicked retail trader dumping positions at market price becomes a willing counterparty. Every algorithm programmed to exit on breakdown confirmation adds more fuel to their purchasing campaign. This is not conspiracy. This is market structure. This is how the preliminary support forms, how the selling climax exhausts itself, and how the quiet, deceptive phase B absorption silently transfers ownership from weak, frightened hands into strong, informed ones. In today's markets, this process appears across every time frame, from 15-minute crypto charts to weekly equity structures. The instruments change. The technology accelerates the speed. But the fundamental human psychology being exploited, fear, urgency, the desperation to stop the pain, remains completely unchanged since the earliest days of Wall Street tape reading. The moment you genuinely understand that professional accumulation requires your panic to function, that without your fear-driven selling they literally cannot build their position, everything changes. That horrifying price drop stops being a threat. It becomes your invitation. That sudden, brutal drop below support, the one that triggers your stop loss, isn't a breakdown. It's a spring. It happens in seconds. A level that has held firm for days, sometimes weeks, suddenly cracks. The price slices through support with shocking aggression. Your stop loss executes automatically. The position you researched, planned and patiently held is gone, closed at the absolute worst possible price. And then, almost immediately, something deeply unsettling occurs. The market reverses, not slowly, not tentatively. It snaps back upward with a velocity that feels almost mocking. Within hours, sometimes within the very same trading session, the price is back inside the range and then pushing higher. You watch from the sidelines, stopped out, confused, and quietly furious, wondering what catastrophic misreading of the market just cost you your position and your confidence simultaneously. Before you conclude that markets are manipulated against the small trader specifically, before you abandon your methodology entirely, you must understand one foundational truth about how price genuinely moves at critical structural levels. That breakdown was not a breakdown. It was a test, a carefully engineered deception, and it has a name that every serious Wyckoff student must permanently embed into their understanding of market mechanics: the spring. The spring is perhaps the single most powerful and misunderstood event in all of technical market analysis. Its entire purpose is theatrical. Large professional operators, having spent considerable time absorbing supply during the quiet, deceptive Phase B development of an accumulation structure, now face one final obstacle before launching the uptrend they have been constructing: remaining supply. Lingering sellers, stop-loss orders clustered just below visible support. Breakout, selling algorithms programmed to trigger on structure violations. All of this represents resistance to their upward campaign. So they eliminate it brutally, efficiently, and with absolute deliberateness. In modern electronic markets, this process has become even more surgically precise. Algorithmic systems identify exactly where retail stop-loss clusters accumulate below key support levels. High-frequency trading operations can trigger cascading liquidations within milliseconds. What appears on your chart as a sudden, momentum-driven breakdown is frequently a coordinated liquidity sweep, penetrating just far enough below the structure's established lows to capture every available sell order, every triggered stop, every panic-driven market exit. The volume spike you observe during this penetration is not evidence of genuine bearish conviction. It is the sound of a transaction being completed, weak hands forcibly transferring their positions into the waiting inventory of professional operators at the lowest possible price of the entire accumulation campaign. Three distinct spring variations exist in real market conditions, from the violent high-volume terminal shakeout to the quiet, almost invisible exhaustion spring that barely whispers below support before recovering. Each carries its own implications for the subsequent move, but every single variation shares one identical outcome: the trap closes. The supply is absorbed. The professionals now control the float, and the only question remaining is whether you recognize the spring for what it truly is. Not the moment the market broke against you, but the precise moment it was preparing to move powerfully in your favor. Large traders deliberately engineer that fear to absorb your shares at the lowest possible price, eliminating weak hands before launching upward. You have been studying charts for months, perhaps years. You understand support and resistance. You recognize volume patterns. You follow price action with genuine discipline and carefully constructed logic. Yet somehow, with almost humiliating consistency, the market moves violently against your position at the precise moment your analysis appears most correct, and then reverses immediately after removing you. This is not coincidence. This is not bad luck, and the most disturbing part of this reality is not that it happens. It is that it happens systematically, with architectural precision, following a sequence so deliberate and repeatable that once you genuinely see it, truly see it, you will never again mistake professional engineering for random market noise. Before drawing devastating conclusions about your own analytical abilities, understand something critical about the modern financial market ecosystem that most retail participants never fully confront. Every significant accumulation campaign requires a counterparty. Every single purchase made by a large institutional operator, a hedge fund establishing a multi-million-dollar position, An algorithmic accumulation program systematically building inventory must be matched with an equal and opposite sell order. The mathematics are absolute and inescapable. Without sellers, there is no accumulation. Without fear, there are no sellers. Therefore, fear is not a byproduct of the accumulation process. It is the raw material. This is the engineering reality that separates Wyckoff analysis from every superficial approach to reading price and volume. Large professional operators do not passively wait for organic selling to appear at convenient prices. They actively manufacture the psychological conditions necessary to generate that selling on demand, at the precise price levels where they have determined maximum absorption efficiency. The mechanism operates across multiple simultaneous dimensions in today's markets. Negative news narratives, amplified exponentially by social media, financial commentary platforms, and algorithmic sentiment analysis, create atmospheric fear that loosens retail holders from their positions. Coordinated price movements toward technically significant levels trigger systematic stop-loss liquidations. Bearish momentum signals activate retail selling algorithms and discretionary traders simultaneously, flooding the market with exactly the supply volume professionals require to complete their absorption campaign. Observe the preliminary support event carefully in any genuine accumulation structure. Then the selling climax. Then the quiet, deceptive phase B development with its deliberate tests of both structural extremes. Each event serves a specific engineering function, progressively transferring ownership, exhausting available supply, eliminating every category of weak hand from greedy breakout traders to fearful long-term holders to precisely timed stop-loss victims. In modern markets operating across cryptocurrency, equities and Forex simultaneously, this campaign unfolds with extraordinary speed. What required weeks of tape reading in Wyckoff's era now compresses into days or even hours on lower timeframes. The engineering is faster, the precision is sharper. But the underlying architecture, the deliberate manufacture of fear as a purchasing mechanism, remains structurally identical. Every shakeout, every false breakdown, every gut-wrenching acceleration through support that immediately reverses. These are not market failures, they are receipts. Evidence of a completed transaction between those who understand the structure and those who do not. The moment you stop experiencing that engineered fear as a threat and start reading it as a signal, as confirmation that professional absorption is actively underway, you permanently change which side of that transaction you occupy. The selling climax, the silent phase B absorption, the deceptive shakeout, it's all orchestrated. There is a particular kind of torture reserved exclusively for the observant trader. You watch a market decline with mounting dread. You see the volume spike violently on a catastrophic down move. You witness the subsequent recovery, the lateral consolidation, the tests of highs and lows that seem purposeless and exhausting. You read every indicator available. You consume every analysis published, and yet the market continues moving in ways that feel simultaneously random and somehow inevitable, as though it already knew exactly where it was going, while you were still desperately trying to determine direction. That feeling of perpetual confusion, of always arriving one step behind the price, of watching moves unfold that seem obvious only in hindsight, that is the specific psychological condition that keeps the majority of retail participants permanently on the wrong side of every significant market move. Consider carefully what you are actually observing before concluding that market movement is genuinely unpredictable or beyond rational analysis. What appears as chaotic, emotionally driven price fluctuation during the development of an accumulation structure is not chaos at all. It is a precisely sequenced operational protocol. And every single phase of that protocol serves a specific, identifiable, repeatable function. Begin with the selling climax, that dramatic, high-volume capitulation event that announces the exhaustion of the preceding downtrend. In modern markets, this manifests with extraordinary visual clarity. Volume explodes. Price ranges expand dramatically. Financial media reaches peak negativity. Retail sentiment surveys register maximum bearishness. Every technical indicator screams oversold simultaneously. This convergence of pessimism is not coincidental atmospheric noise surrounding a random price event. It is the opening movement of a carefully composed campaign. The automatic rally that immediately follows serves a dual architectural purpose. It establishes the upper boundary of the developing structure, while simultaneously generating the first meaningful evidence of buyer interest entering the market. The subsequent secondary test then confirms whether that selling climax genuinely exhausted available supply or whether additional absorption work remains necessary. Then Phase B begins, and this is where modern traders consistently misread the market with the most costly consequences. Phase B appears boring, deliberately engineered lie boring. The lateral price movement, the diminishing volatility, the gradually declining overall volume, these characteristics cause impatient retail participants to abandon positions, declare the security dead capital, and redirect their attention toward more immediately exciting opportunities. Meanwhile, institutional accumulation programs are systematically absorbing every available sell order, every discouraged holder liquidating positions, every algorithmic exit triggered by prolonged consolidation signals. The upthrust action testing structural highs, the secondary test probing support lows, each event methodically eliminating specific categories of remaining supply, while simultaneously confirming the directional commitment of the professional campaign. Then the shakeout arrives as the final devastating movement, sweeping the last pockets of resistance with surgical precision before the campaign's true intention becomes undeniable. In today's algorithmic trading environment, this entire orchestrated sequence executes with machine-like efficiency across every liquid market simultaneously. Cryptocurrency accumulation structures develop identically on 15-minute charts. Forex accumulation campaigns unfold with recognizable phase sequences on 4-hour timeframes. Equity accumulation structures develop their complete symphonic sequence across daily and weekly charts. The orchestra never changes its composition, only the tempo varies. Once you genuinely internalize that every event within an accumulation structure, from the opening selling climax through the silent phase B absorption to the final deceptive shakeout, represents one movement within a single, unified, purposefully orchestrated campaign, the market permanently transforms from an anxiety-producing adversary into a readable, tradable sequence of cause and effect. You stop reacting to individual notes in confusion. You start hearing the entire symphony. Once you recognize the structure, you stop being the liquidity. You become the one riding it. There is a devastating mathematical reality embedded inside every single accumulation structure that most retail traders carry with them throughout their entire trading career without ever consciously confronting it. Every stop loss you have ever had triggered at the worst possible moment, every position you have ever liquidated directly before a powerful reversal. Every time you sold into a breakdown that immediately recovered and launched into a sustained uptrend, you were not simply experiencing bad luck or poor timing, you were functioning exactly as designed. You were the liquidity. Your fear-driven sell orders, your algorithmically triggered stop executions, your emotionally exhausted capitulation at the absolute bottom of a selling climax, these were not trading mistakes in the conventional sense. They were inventory, raw material, the essential fuel without which no professional accumulation campaign can successfully complete its absorption phase and initiate the subsequent uptrend movement. Every single time you lost, someone else won. Specifically, deliberately, using your predictable emotional response as their purchasing mechanism. Sit with that reality for one complete moment before reading further. because what follows is not a continuation of that disturbing truth. It is the complete reversal of it, and the reversal is available to every trader willing to genuinely internalize what the preceding 4 keynotes have been systematically building toward. The Wyckoff methodology does not simply explain why markets move the way they move. It provides something far more operationally valuable, a repeatable structural framework for identifying precisely when and where professional accumulation campaigns are actively underway, and positioning yourself in alignment with that campaign before the uptrend launches rather than desperately chasing it afterward. Understanding Phase A's stopping events tells you that the preceding downtrend is exhausting itself. Reading Phase B's silent absorption correctly tells you that institutional inventory building is actively progressing. Identifying the Phase C shakeout, that final, devastating false breakdown designed to eliminate the last remaining weak hands, gives you the single highest probability, highest risk, reward entry opportunity available anywhere in the entire market structure. In modern trading environments operating across global equity markets, cryptocurrency exchanges, and 24-hour Forex sessions simultaneously, this structural recognition carries extraordinary practical power. Accumulation structures develop identically whether you are analyzing Bitcoin on a 1-hour chart, the S&P 500 futures on a daily time frame, or individual equities across any sector. The phase sequence remains consistent. The event progression remains logical. The volume behavior during absorption, during the shakeout, during the sign of strength breakout, and the subsequent last point of support confirmation, all of it follows the same readable, recognizable architectural logic regardless of the instrument, the time frame, or the decade. The spring test entry, the backup to the edge of the creek confirmation, the last point of support within Phase D's developing uptrend. Each represents a specific, identifiable moment where structural analysis transforms directly into operational opportunity, with clearly defined entry levels, logically positioned stop, loss placement, and measurable risk, reward ratios that consistently favor the prepared, structurally aware trader. This is the permanent transformation that genuine Wyckoff understanding produces. Markets that previously generated confusion, anxiety, and consistent losses begin revealing their internal logic with increasing clarity. The same price action that once triggered your stops and emptied your account now reads as a transparent sequence of cause and effect, a structural narrative written in price and volume that tells you exactly what the most powerful participants in the market are doing when they are doing it, and precisely where they intend to take the price next. You were never meant to remain the liquidity forever. The structure was always readable. The campaign was always visible to those who knew the language. Now you know it. Stop funding their positions. Start riding theirs. The structure was always readable. The campaign was always visible. Now everything changes. Consider for one brutal, honest moment the cumulative weight of every loss you have ever absorbed in the financial markets. Every position stopped out at the exact worst moment. Every panic liquidation executed directly before a powerful reversal. Every time you watched a market you abandoned immediately launch into the sustained uptrend you originally anticipated, the one you were perfectly positioned for until fear systematically dismantled your conviction and replaced it with doubt. Then desperation, then capitulation. Add those losses together. Not just financially. Add the psychological cost, the sleepless nights spent questioning your analytical abilities, the creeping suspicion that markets are fundamentally irrational and therefore permanently unreadable, the devastating erosion of confidence that accumulates across months and years of consistently arriving one step behind every significant move while never fully understanding why. That accumulated damage was not the consequence of insufficient intelligence or inadequate dedication. It was the direct consequence of reading individual price movements without understanding the structural campaign orchestrating them. Everything presented across these 5 keynotes has been building toward one single, unified, operationally transformative conclusion that every serious modern trader must permanently install into the foundation of their market understanding. Markets do not move randomly. Significant price movements do not emerge spontaneously from collective emotional noise. Every sustained uptrend that has ever developed across every financial instrument, in every market, throughout the entire history of organized trading, has been preceded by an accumulation campaign, a deliberate, systematically executed, sequenced process of supply absorption conducted by professional operators who understood precisely what they were building and exactly where they intended to take the price upon completion. The selling climax that devastated your confidence was their opening purchase. The silent, boring Phase B consolidation that exhausted your patience was their inventory building process. The violent shakeout that triggered your stop loss and removed you from your position was their final acquisition, the last deliberate engineering of fear necessary to capture the remaining available supply before launching the campaign's intended effect. Every phase served a function. Every event followed a logical sequence. Every volume signature told an honest, readable story to anyone possessing the structural framework necessary to interpret it correctly. In today's markets, algorithmic, high-frequency, globally interconnected, and operating continuously across every asset class simultaneously, this structural logic has not diminished in relevance. It has intensified. The campaigns execute faster, the shakeouts penetrate more precisely, the absorption phases compress more efficiently. But the fundamental architecture remains completely intact because the underlying human psychology being systematically exploited, fear, impatience, the desperate need to stop financial pain, has not changed in the slightest since Richard Wyckoff first observed these patterns through the tape reader's lens over a century ago. The preliminary support still announces the campaign's opening. The selling climax still marks the transfer of ownership. Phase B still silently builds the cause. The spring still delivers the final deception. The sign of strength still announces the campaign's completion, and the last point of support still offers the prepared, structurally aware trader their final, confirmed opportunity to align with the most powerful directional force operating in the market. This is the complete language of accumulation, not a collection of isolated patterns to memorize mechanically, not a rigid labeling system to apply inflexibly across every chart, but a living, breathing, structurally coherent framework for reading the genuine intentions of the most powerful participants in any market and positioning yourself in deliberate, calculated alignment with their campaign before the price movement their absorption built finally delivers its inevitable effect. You have spent enough time being the counterparty. You have funded enough positions that were not your own. You have provided enough liquidity to campaigns that enriched everyone except the trader executing the orders. The accumulation structure was never designed to confuse you permanently. It was only impenetrable for as long as you lacked the framework to read it. That framework now exists in your hands. The only remaining question, the one that separates every trader who transforms their results from every trader who continues repeating the same costly patterns indefinitely, is devastatingly simple. Will you keep reacting to the structure, or will you finally start reading it?